I have Larry Goldberg here as he should be because it is the first, well, is it the first Saturday of the month? Yeah, I guess it is.
Yeah, it's the sixth day of the month, I
That's right.
guess.
Yeah. So
Yeah, sixth day. So it's the
yeah,
last day before the first Monday, second Monday.
like a Monday.
Yeah.
So that means that it's the day after the first Friday of the month
Friday, yeah.
when Cathie Wood does her thing and talks about Employment Friday. So I'm gonna bury the lead. I'm not bury the. I'm gonna just hit it right out of the park here from the beginning, Larry. Cathie Wood believes that we are going into the golden age starting in the fourth quarter, and that will continue into the new year, into 2026, and it's just going to get better and better and better. And there you go. That's the whole show. I'll see you later.
And Larry Goldberg believes that it's not going to be that easy or that quick.
Okay. All right.
The law in economics, the iron law of economics, the Larry Goldberg iron law of economics is everything takes longer.
Longer than anybody's expecting, eh?
Everything just takes longer.
All right. Well, so there
Iron
we go.
law.
All right. Let's take a look then, Larry, at the scoreboard. She had quite a number of new ones. I don't know if you brought all the new ones into play, but I'll be interested to see what you've come up with.
So, can you see my screen?
I can see your screen.
Does it look okay?
It looks phenomenal.
Because as we know, I got hacked and it's taken a considerable amount of work to get everything back on track.
Yeah.
So September the 6th, 2025, Cathie said, job stumble, now what? And that's the lead.
Yeah.
Job stumble. I mean, the report yesterday was not a good report, which made everybody happy.
Yes.
Because now they think that, too late. What is Trump called?
Yeah, he calls him too late, Powell, or yeah.
Too late, Powell. Too late, Powell may have been too late. I actually think he was too late.
Way too late, yes.
Yeah. So this is the headlines as we learned them, that unemployment rate is steady at 4.3%, which doesn't sound too bad, right?
No, and in fact, I had to correct her in my head because it was actually went up from 4.2 to 4.3.
Yeah.
And every economist that I've seen, every single one, this is one thing they agreed on. Anything between 4.1 and 4.3 is fine. Yeah.
I think that's what she really meant, right?
Yeah. Yeah.
But non-farm payroll growth, extremely weak.
Yeah.
Only 22,000 jobs added. But you and I have spoken again and again on this subject. These numbers are not to be believed, either the high numbers or the low numbers.
We have no idea what it'll be next month.
Exactly right. But the work week dropped 0.5%, which is a significant reduction in hours. I think that's the most worrying part of this particular report.
Yeah.
Manufacturing sector remains negative.
Yep.
And tech sector showing surprising decline, which may be telling us that the AI revolution is real. And, whenever we have these situations where you have new technology coming in, the first impact is down.
Right.
Before the upside of the good side of the revolution comes. But Cathie did have this very interesting slide that I think is somewhat explanatory of what's going on. And she talks about labor force participation versus the velocity of money.
Mm-hmm.
Now, I am the guy who keeps on saying, look, it's not all about the growth of the money supply.
Right.
It's as much about velocity of money as it is the growth of the money supply.
And this other economist agrees with you, Larry.
Good. So, now that you have the two finest economist minds agreeing that as Haskell, you're right. So what we've got in the green is the velocity of money, M2, but she shifted it like 18 months, I believe,
Right.
because the velocity of money actually has an impact 18 months later. And then she's got the labor force statistics, civilian labor force participation rate, women and men 16 years and over. And you see that the velocity of money has trended upwards, and with that has trended up, the participation rate.
Right.
So if you look back over time, you'll see that in times of recession, these gray bars are times of recession. And I don't need to say that every time we look at charts again, but everybody should recognize this means recession. You see this plunge, both in the velocity of money and in the participation rate.
Right.
Which is why I believe we have been through a very significant recession. You see this number here?
For sure.
This is an indication of a very significant recession. And, those that call the recession, I've said this very often on this program, have just failed to recall what has been a very real recession. And this is what we're going through right now. Now, the recession hasn't followed the classical pattern because of the extremes that we've experienced, both the COVID extreme and then the huge injection of pure cash into the economy, both in the end of the Trump administration, and completely without cause or justification, the enormous amounts of cash that Biden threw into the economy in two very big slugs. So that, we've seen this big rise, and we've seen this, somewhat incremental increase in participation. But look how far behind we still are.
Oh, yeah, 100%. Yeah.
So I regard this as being a recessive period. And, Cathie calls it a rolling recession. I think it's a recession.
So Larry, you and I have talked about this a million times before, but just to bring people up to date, you and I have talked about two kinds of recessions. We have the Cathie Wood version of it, where she talks about the recession being in three major business categories, which is housing, manufacturing, and transportation. Those three are tied together because with manufacturing being down and housing being down, transportation is naturally going to be down. You're not moving all that product around. So those three have been in recession now for 3.5 years. And the other recession that you and I talk about, as much as I agree with her, and I think you do too, the other recession is the under 100,000 income folks versus the over 100,000. I think pretty much everybody's now getting that. I'm starting to see lots of the economists and pundits starting to talk about this divide you and I have been talking about for 1.5 years.
Yep.
People under 100,000 not doing well. People over 100,000 doing just fine, and it's a big divide. The other thing, Larry, I wanted to bring up on this is that the major corporations, and even to some extent the mid caps, have been holding on to employees for a very, very, very long time. They were afraid to get back into the problem they had during COVID, and just after COVID, where they couldn't find any employees. So they've been warehousing employees. They've also been warehousing employee openings, job openings that didn't exist.
Yep.
When we see this big drop off in JOLTS, it's partially because people are taking those out now because they no longer need that buffer. And when we see this slight decline in the increase in the unemployment number, it's partially because these companies are allowing attrition to take place of those employees that they otherwise been hanging on to with dear life.
Not to mention the roll-off of the growth of government.
Yes.
We've seen government, begin to decline for the first time in 4 years. We've seen a very significant drop-off in employment by the government.
Right.
And so I think we're going to see, a sort of double whammy, what you talked about and what I'm talking about. And I think together it has a real impact. And so I think I think there's a lot more bad news to come on the employment front.
Okay.
So the duration of unemployment is also a deep concern, because the current average unemployment duration is now 24.5 weeks, which is a huge increase from 19 weeks in 2022. And it exceeds the typical recession level of 20 weeks. And it's never recovered to the 10 weeks pre-COVID. So there's pre-COVID.
Mm-hmm.
Yeah, that spikes, the spike, that we had with, oh no, this is the treasury yield. Why?
Yeah, she is that your fault, or she had some problems with her slides? I know. Yeah, that's
no. This is Manus.
Oh, this is a Manus mistake, huh? Okay.
Yeah. I might have the wrong deck. I've had a huge problem. I used Manus to put together the summary and the slide and the deck, and I've been through several iterations with it. But anyway, let's move on. So Cathie said, look, all of this is just noise for the moment. This is what we have to get through. But the principal thesis of ARC is the 5 innovation platforms, and she thinks they're ready for prime time. She thinks we're going to hit it now. Robotics, automation across manufacturing services, energy storage, the transition to renewable, artificial intelligence, that's the whole AI thing, multi-omic sequencing. I think this not only talks to the sequencing of the genome, but also the general revolution around genomics, not only deriving from sequencing,
right,
and blockchain, that is going to, promote digital ownership. I'm not signed on to every single aspect of her view of these platforms, and others may disagree with what I think is going to be important. But certainly this covers the gamut of what we see breaking out now in technologies. And of course, nothing is hotter right now than artificial intelligence. And, this may prove to be a bit of a bust for a while before it becomes the ultimate success that it's going to be.
Some people are comparing it, Larry, to the 90s, and I saw one gentleman yesterday comparing it to where we were in 1995, and that we really didn't start seeing the big jump in the stock market or productivity until 1997. We have Tom Lee on the other side, who both you and I appreciate, who thinks we are at 1997. So that we would be right on the verge of seeing massive productivity increases.
I think I can say with a degree of conviction that only comes from my level of stupidity that they're both wrong.
They're both wrong. Okay.
Yeah, they're both wrong. I don't think it ever, history doesn't repeat, it rhymes.
Right. Yes.
But we definitely are going to go through, several waves of, disappointment and humility and excitement and so on and so forth. So I think we're going to go through waves, and I don't think we can say it's like we're in this particular month of this particular year. I will say, though, that, MIT came out with a study that seems to have everybody's head buzzing, where they said, there hasn't been any pickup in efficiency. And I think, like most MIT studies, it's bull. Yes.
Yes.
I shouldn't say like most MIT studies. Like many today, it's just a load of bull hockey.
Yeah.
All right. So, but look, I'm aligned with Cathie 100%. These technologies are going to have a profound effect
Right.
on our future.
100%.
I just don't know when that future is going to happen.
Right.
I do know it's going to happen at multiple times over a fairly extended period of time.
Yep.
That is my conviction.
Yep. It'll roll in.
It'll roll in. It'll be a rolling accession.
Yes.
So Cathie sees that she thinks we have a path to a surplus in our budget.
Yeah.
Which must come as a shock to some people who think we're going into this incredible budget deficit. We're already at 4.8. People are calling for 6% right now. The target, Besant's target is 3%.
Right.
He thinks we can grow this economy at about 4.5. I don't know what his target is. I'm thinking it's 4.5. Cathie's target is 6.
To grow it. Yeah. The productivity increase is 6.
Yeah. No, she thinks we can grow the economy at 6%. And if she grows the economy at 6%, there won't be a deficit at all.
Right. 100%. And she's right.
She sees tariffs contributing, between $400 to $500 billion annually to the deficit reduction. The real GDP surge she expects in late 2025 to 2026. This is where she and I disagree.
Mm-hmm.
I think everything, the iron law is everything takes longer.
Right.
And she said, following the Reagan-Clinton era playbook, she thinks the surplus will occur in 4 to 5 years from now. So we can see this green line going up, purple line going up according to the green line. That 3% is Besant's target. But she thinks we're going to get, up here, which we did briefly in 1990 until everybody splurged away on many, many wars.
Yeah.
So interest payments currently exceed defense budget, creating market concern. I think that the problem that interest payments exceeding the defense budget isn't the problem. I think the problem is that human HHS is exceeding everything.
Yes.
Anyway, that's the fiscal path that she sees to surplus.
Mm-hmm.
And she thinks the deregulation has begun the process, because that's the other wind behind our back, that we're deregulating. The first executive order Biden rescinded was AI deregulation, crypto deregulation, legislative changes and court system victories. I'm not sure that I see that crypto is going to bring the lubrication that the crypto geniuses see. I think that there's a lot about crypto that still has to be worked out. I just don't see it promoting the velocity of money that money promotes.
Right. Yeah. Some Tom Lee again, I think it was, who was talking about the other day that once Goldman Sachs and a couple of the other big banks get really serious about this, which apparently they are.
Oh yeah, they are in a big way.
That we could begin to see some of this lubrication that you're talking about.
And that lubrication will happen within the banking system, not outside the banking system. That's my belief.
Yep.
Nuclear energy, addressing 50 years of regulatory constraints. And again, this is something that's not going to happen in 3 years.
Yeah.
And small modular reactors. So, China's currently constructing 28 large-scale nuclear plants. We are constructing exactly 0.
Right.
And I think it's going to remain exactly 0 for a while, despite all the noise. And so, again, this is something I see in the out years. So if you look at all of this, the AI deregulation, which was the removal of a negative constraint, not a positive development, but this is all about deregulation. I think that's the one thing I can say with certainty is going to have an immediate impact. And the thing was, Biden didn't have time after he issued that order to actually impact the rate of development of AI.
Right.
It was just going ahead, helter-skelter, regardless of everything this old man tried to do, sitting in his in his wheelchair in the residence while his team gaily, operated the auto pen.
So, Larry, I just want to add to this that the
Please.
deregulation is happening behind the scenes that the press is not even slightly reporting on. They are they're eliminating regulations by the thousands. This has been reported only slightly, but every department has been called upon to go into their regulations and to eliminate any regulations that are nonsensical or that don't fit within the new law, having to do with whether the various departments can have tribunals or have their own rules and et cetera. So this deregulation is really happening at a rapid rate and should be, as you point out, showing up in the economy fairly.
And I think that's Cathie's really pointing that out. And she's saying that this is what happened in the Reagan administration.
Right.
And by the way, it happened in the Clinton administration as well.
Yes, it did.
And it's a lot of this accretion has happened since those days.
Yep.
And not only that, but the Supreme Court has been very helpful.
Yes.
In striking down some of these ridiculous laws or rules.
Yes.
They weren't laws, they were rules that had been implemented, extra legally.
Yes.
As a lot of the things that happen in the government today. I mean, if we didn't even need constitutional scholars that believed in the literal,
Yes.
We needed constitutional scholars that simply observed the meaning of the words of the Constitution.
Right. Yes. That's what
they didn't have to be originalists. They just had to apply the law as it was written. Anyway.
Yep.
Still not there yet, by the way. Now, the one thing Cathie did focus on for a while and is really meaningful is the tax incentives.
Yep.
This tax bill was revolutionary. And I remember these tax laws going back many, many years, and they were revolutionary at the time they were implemented in the 70s. But this together with what is going on, like manufacturing structures being able to be written off in 1 year instead of 30 years. Mm-hmm. Do you know how important that is if you're building $1 billion AI training cluster?
Well,
multi-billion dollar.
Yeah, Larry, all of that's important. But I can't get over the fact that Cathie Wood does this too. So many people do. 60% of the U.S. economy is small business. So this matters to a small business owner who's running a little factory like I was with 100 people, or even with 20 people, who wants to make $100,000 purchase of a piece of equipment.
Absolutely, it is very important. It's critically important.
Yep. Critically important. So this is going to be right across the economy.
Yep. And she says so. I mean, if you look at the global expenditure as a whole, it doesn't matter where it comes from. Mm-hmm. And so if your capital expenditure doubles in 1 year or doubles in a 2 or 3 year cycle, that is a huge stimulus to the economy, but nothing like the stimulus over the next 20 years.
Exactly.
As that machinery gets used.
And the Atlanta Fed GDP tracker, which went up from 3.0 to 3.5, it's gone back down to 3.5, up to 3.0 now. But the thing that is holding it up at the levels it is now, capital expenditures.
Yeah, we need to. I mean, it's very frustrating, actually. There are quite a few frustrating elements to that. Yeah, so, she points out that the U.S. tax rate is now below that of Hong Kong or Ireland, or is equal to Ireland. By the way, Ireland got heavily sued by the EU for having that tax law and finally won their case.
Yeah.
They took a lot of money out of the United States,
They did.
A lot of money.
Computer, for instance.
Yeah, absolutely. So, famously, Apple made all their profits in Ireland.
Yeah.
So monetary policy, tight and deflationary.
Yes.
This is like, you know, you want me to start my rant on Powell again, or should I?
No. Yeah, it's all said right here.
Yeah,
The real rate of inflation. There's the real rate of inflation is
right there.
Yep.
2%. I mean, there's a decimal point above 2% or a decimal point below, you know, 1 or 2 decimal points above. I mean, classically, the Federal Reserve Bank says, look, we don't want to go below 2% because there's dangers in that. There be dangers in that, swamp. And so they say we don't want to do that because of the possibility of deflation. That's why we chose 2%. So we get very cautious as we approach 2%. Very cautious,
right?
Because if we're going downwards and we're approaching 2%, we say, well, stop all the monetary work, let the economy take care of it. Not too late, Powell. Sometimes Trump's, monikers work very well.
Right, that's right.
So we've been building a deflationary narrative since 2009 because of this yield curve inversion stuff. And 3-year rolling recession affecting manufacturing, housing, low middle income consumers. Fed rate cuts may steepen curve, but failure to exceed 150 basis points, 1.5%.
Yeah.
Would it reinforce deflationary expectations? So Cathie's really laying down the gauntlet here.
Yep.
By the way, I believe that we've been in I guess I've said it like 15 times so far, but I'm going to say it again. I believe we've been in a recession, real recession, not a rolling recession. We've been in a recession with the exception of 10 companies at the top of the...
Right.
So inflationary outlook heading to 0. Current CPI at 1.9% despite tariffs. Projected to reach 0 or negative in coming years. Innovation is inherently deflationary. Look, the greatest years of innovation in this country were the railroads, all the way to electricity, all the way to the telephone, all the way to,
automobiles and airplanes.
Automobiles, airplanes, the internal combustion engine, that was the greatest period. And there were years of deflation in those periods.
Mm-hmm.
So we have M2 velocity declining with labor participation. And we have global deflationary forces in aging demographics, technology adoption, debt overhang. This Fed is going to be so sorry in history that it didn't move earlier.
And, one of the things they're paying attention to, we've talked about this a little bit, Larry, on various other shows. They're paying so much attention to this Michigan survey of consumer sentiment, they call it. And Cathie even mentioned the Michigan survey, and she said she's lost faith in it.
Yeah.
And part of the reason she said it might have been the way they're collecting the data or the way that they're asking the questions. I think part of it is that they don't have a control over is that the bifurcation of the consumers now so anti-Trump and so pro-Trump, you got 99% either way, that that the people they're asking, if they're anti-Trump, they're saying, oh yeah, we think inflation is going to go to 9%. This is crazy. Nobody actually believes inflation is going to 9%. But saying it, and they use this information to come up with their thoughts about how to base the economy.
In this modern age, why are we relying upon some sort of poll for our economic information?
The data's there.
The data's all there.
Our data's available.
We should get, and there are guys who have that hard data and produce it.
Yeah. We got Zillow, we got Trueflation. So many, I mean, holy mackerel, it's so easy now.
Well,
Speaking
the
of
one,
Zillow,
so yeah, so the housing market is really, in crisis. Our home sales are below the world, the global financial crisis levels of 2008 and 2009. That's how bad it is.
yeah.
Look at this. 2008, the world was coming to an end. Well, the world has ended. It's not coming to an end. It has ended for a very large segment of the population. New home inventories, I'm about to put my house on the market,
Right.
at pre-2009 crisis levels. Builders shifting to price cuts to clear inventory. Mortgage rates at multi-decade highs, despite inflation moderation. An entire generation has been priced out of home ownership. Thank you, Jerome Powell.
Yes. Now, interesting. Rasmussen out with the poll this morning. Breaking news. Rasmussen says they polled individuals under, I think it was under 25 or maybe under 30. Anyway, young people, asking them what was the main reason that they're interested in somebody like Mamdani, not whatever.
Mamdani.
Yeah, yes. Why they're interested in him as mayor. And the number one reason was the cost of housing. And yet the cost of a home, of a house, of buying a house. And yet Mamdani doesn't want to lower the cost of housing. He wants everybody to rent. So I don't know. I think people are confused about what it is that he wants to get done. But the point is, this is now becoming the number one issue among people under 35 is they can't afford a house.
Yeah, I mean, it's really a bad situation, really bad situation. But, back to this productivity boom, and I think these slides are out of order somewhat the way I had them because of the problems I'm having with my computer. But here we are again. This issue of current productivity growth is about 2% year over year, but we're projecting it to surge to the 5% range. Step function increase driven by the innovation. Potential GDP growth 5 to 7%. Real growth, which is 7 to 9%. Numerical growth or nominal growth. So innovation-driven productivity will be the primary engine of economic growth, says Cathie. I think it's true. I think it may be a couple of years further down the road than she thinks, but I think it's coming.
Absolutely.
And Cathie says that we're in this rolling recession with manufacturing, housing, and low middle income consumers increasingly affected, finally elected to be shorter and less severe than typical recessions. I truly hope she's right. I just think these things take longer to turn around than she thinks. And, it's the yield curve issue. Firstly, we've never seen a yield curve drop like this and not have a recession.
Oh, yeah.
And that's why I think that the people who score it and call it a recession are going to have to, really go back to their books. This is this yield curve where the 10-year Treasury yield minus the 2-year Treasury went negative for so many months. And I remember you and I predicting, it's going to turn, it's going to turn, it's going to turn. And it always takes longer. That's the iron rule, right? And, here we are. It's turned. I think what we are in is truly a recession, or what we have been in is truly a recession. And I think until the Federal Reserve relents, I think we're not going to see clear evidence that we're out of it. We're not going to see incomes increase. We're not going to see housing values increase. We're not going to see job growth, real job growth. I don't mean ghost jobs growth.
Yeah, and Larry, the only place I'm going to disagree with you is on the real incomes are increasing, in fact, and that's the exciting part, because this is what Trump is all about, is getting those real incomes to increase. And so far this year, real incomes are increasing. So, in fact, in the housing, I'm
But
sorry.
again, that spread of if you look at within the number,
Mhm.
that spread is very, very seriously bad, because the real income is increasing because it's increasing at the top end. It's not increasing at the bottom end because those people are either out of work or they're underemployed. And so it's not a good situation. And those numbers hide, a really serious problem. Because where is the recession? It's not amongst the people who are employed.
Right.
It's amongst the people who are
Unemployed. Yes. Right.
or unemployed. So investment implications. Quality of earnings matter more than ever in this environment. Companies harnessing new technologies will benefit disproportionately. They certainly benefit disproportionately from investment.
Right.
Deflationary environment favors innovation platforms and disruptive technologies. Traditional sectors face margin compression and disruption risk. But I will tell you, my portfolio has done extremely well this year, not because Tesla went up from something to something else, and I have a very large proportion of Tesla in my portfolio, but because I've invested quite heavily in infrastructure stocks,
Right.
in brick and mortar
Mhm.
stocks,
Mhm.
believe it or not.
Mhm.
And those brick and mortar stocks have outperformed Tesla,
Mhm.
and they've even kept pace with NVIDIA,
Wow.
some
Yeah.
of them,
Wow. Yeah.
So, yeah, she's right. Innovation platforms are going to be strongly positive. But right now, traditional manufacturing and housing construction is negative, but the indications are very good, very, very good.
Yes.
Okay. So her bottom line, as always, is innovation through disruption. Innovation is going to drive growth. The short-term challenges are weak employment, with only 22,000 jobs added, housing crisis with affordability. And then we talked again about the 5 innovation platforms and the 5 to 7% real growth.
And Larry, I do have to say it. I do have to say this again on employment, or I said it on my show already, but let me say it here, is that this employment number of 22,000, while it looks weak, is actually going to turn out to be the new normal. Now, it might be 50,000, it might be 75,000, but it's not going to be 175,000 while the federal government isn't hiring. It's not going to be 175,000 until the economy picks up a lot.
True. No, you're absolutely on target.
Right.
Because really, employment aggregates are not bad at the moment.
Right.
But we've both pointed out that there's a lot of artificial padding in those numbers, and we have to work through that.
Right.
Okay. And then there are just 2 more slides. Everybody have a little bit of patience with me. No, there aren't 2 more slides. You see, it was the wrong deck.
Oh, it was the wrong
deck. Yeah, unfortunately, I had this problem today about trying to recover my computer and get organized.
Yes. Well, were they important, Larry?
No, actually, I think it was just a different order. As you saw, they were a little bit out of order.
Yes. Yeah. So again, I think the overall idea is that Larry and Cathie and I would all be on the same page with slight variations.
Yeah.
That the economy is still, it's okay. It's not doing, Larry thinks it's in recession, and that's okay. The definition of recession is pretty difficult to really ferret out. For some people, the economy is definitely in recession. We have some excitement coming that now, as we go into the fourth quarter and the first quarter of next year, Trump's number one focus is going to be on housing. I think that maybe this is going to be unnecessary because I'm not sure that we're not going to see maybe a 10 to 20% drop in the average cost of housing over the next 12 months. So Larry, selling next spring may be the wrong time. You may want to see if you can rent it out for a year.
No, actually, I'll tell you something interesting. I don't fear a drop in the cost of housing.
Okay, good.
It will be vastly offset by a drop in the cost of a mortgage.
Right. Eventually, that will have its impact, but I think
new housing to replicate my house.
Yeah.
New house would be like 50% more in terms of cost of house than this house is currently valued at. And so I think that on balance, we've got to get through this issue of affordability.
Yeah. So here's my theory. Let me throw out my theory. Just we got 3 minutes here. We can put my theory out and you can refute it. I think we're in a really big overhang of inventory right now. One of the biggest inventories we've had for 25 years, and we don't have anybody lining up to buy it. We're going into the winter. We're going into the off season. So this is typically when people are not buying. Now the mortgage rates will drop, and that will bring some people back in. And as they come back in, some of that overhang will probably be grabbed up over the winter. I won't be surprised to see a pretty good winter in terms of home sales, but the overhang is so big, it's not going to all get sucked up. So, and I think the mortgages will continue to go down all winter long. And in the spring, we'll still have decent inventory when the spring season starts again. And then maybe over the course of the next 6 months, maybe we'll start to see some of that inventory go away. But what we'll have in the meantime is I think we will see maybe 10 to 20% nationwide drop in housing prices. But unlike other times, it won't accelerate. It won't be a race to the bottom, because that inventory will eventually be grabbed up, and then we'll start to see some improvement again. That's my theory.
I think we're going to see a very good spring season. That's what I think. I don't think we're going to see a significant drop in pricing.
Okay.
I think we may see an alleviation of the price of new houses, but anyway, we'll see.
All right. Okay. All right. So there you have it, folks. Let us know in the comments below what you think about all of that. And we will, of course, do this again a month from now when we'll have another month of this economy to play with and look at and see how the Trump folks are getting done. Larry, do you think it's Trump's economy now?
Oh yeah.
Okay. So we're going to
I mean, as soon as Powell gets in line or leaves, whichever is the sooner, then it's Trump's economy. Right now, Powell is a damper on the economy. But you know that the Federal Reserve can't be a damper forever,
Right.
I mean, Powell leaves in May anyway.
Right. Okay. So we've got the Trump economy. We can agree on that. And it'll be even more the Trump economy after a week from Wednesday, when the Fed lowers the rate. All right. Okay, Larry, as always, thank you for putting together the deck. We'll give you a pass this week for computer problems. And of course, it's always the highest tech guy that has the computer problem. Is that right?
Well, I was due. I haven't had computer problems for like 15 years, so I was due.
All right, Larry. Thanks again. And to all of you out there, it's been great talking to you.